Assalamu alaikum friends, welcome to question number 28. This is the question from section B of 25 marks, and this question is also our latest question because this is from your September-December 2019 guidance. So let's see, and as you can see that here we have some ratios. You can see return on equity, then if you move on we can see some special purpose entity, then we have some miscellaneous transaction, then we are required. So let us first read the requirement before we read the scenario. Section B question, especially question number 4. Okay, question 4 can come in questions like conceptual framework, management commentary, your ratios can come here. Okay, so guys, in SBR you also need to learn the ratios. You have to know the formula of the ratios because ratios can be tested equally, right? Even though ratios are not tested extensively like how you are tested IFRS and IAS knowledge, but ratios you have to. One question you will be getting on ratios. Okay, so you need to know the ratios, the formula for ratios. Definitely you will not get a question 10-20 where you have to calculate 10 12 10-20 ratios, but 4-5 ratios you should know, which are very common ratios. For example, return on equity, return on assets, working capital, your profitability ratios, investor ratios, EPS, this type of ratios comes. Okay, it's quite common. So this questions, these ratios and all are, they're not related to a specific standard. They're not related to IFRS and IAS. They're general. And also you will be asked questions on current issues, sustainability reporting, environmental reporting, all those things. Okay. For environmental reporting, sustainable reporting, we don't have a specific standard for this. So these are like general, integrated reporting. These are general. Okay. You need to learn this aspect as well of SBR. So let us go with the requirement. Requirement A, we need to read a small paragraph before answering, which is for 6 marks. Management's intent and motivation will often influence accounting information. However, corporate financial statements necessarily depend on estimates and judgment. Financial statements are intended to be comparable, but the analysis may not be the most accurate way to judge the performance of any particular company because they have estimates and all. Because every company might measure a same thing in a different way. Some company, for example, depreciation, company A might be taking straight line basis, company B might be taking reducing balance basis. It's hard to compare, right? That's why they say that it is not the most accurate way to judge the performance of any particular company by comparing. It lacks comparability due to different accounting policy choices as well as deliberate manipulation also. Sometimes you might deliberately manipulate a financial statements. What are you required to do? Discuss the reasons why an entity may choose a particular accounting policy. Why they might choose. Here you have to give reasons. This is not relating to a specific standard and all. Okay, where an IFRS allows an accounting policy choice. Not every standard allows, but some standard allows you that accounting policy choice. For example, IS 16. IS 16 says you can use the cost model or the revaluation model to value your assets, non-current assets, intangible assets, investment properties. This gives you an accounting policy choice. So, so which out of the choice, for example, cost and revaluation, which method are you going to choose? You have to give reasons why you are choosing a cost model or why you are choosing a revaluation model under IS 16. Okay. So you have to mention those standards, IFRS standards, which allows you this choice. And whether the faithful, so and the word and means this is a separate requirement. Okay. Half for this, half for the next one. Whether faithful representation and comparability are affected by such choices. That means these are the features of what? Qualitative characteristics of useful information, right? You have to link this with the conceptual framework for 6 marks. Coming to B. B, you have to read this, you have to use this scenario or this case study for answering B, okay? The ratios and all. So discuss the usefulness to investors. To whom you have to discuss. It's very important whenever they are asked to discuss something, you have to first understand to whom you have to discuss, from whom, whose perspective you have to answer. Okay, so this is for the investor. Discuss the usefulness to the investors of the ROE ratio and its component parts provided above. There are so many other ratios also which makes up ROE. You have to comment on that also. Why it is useful for the investor. Not only that, you have to calculate these ratios for the year ended 31st December 2005 as well as 2006. And this calculations will be based upon the information provided in table 1. Very easy, very straightforward question, because they told exactly what are the ratios you need to calculate, what are the years you need to calculate the ratios for, as well as from where you have to take the information to calculate those ratios. Very easy, straightforward. And you will be getting questions where you have to calculate ratios. If you get, okay, you have to know it because it's not there in your formula sheet. These are assumed knowledge from your financial reporting. So in SBR, you are supposed to know the ratios, any ratio, okay? The formula for all the ratios. Discuss the impact that the setting up of the SPE and the miscellaneous transaction have had on ROE. So they are specifically referring to this and this that will have an impact on ROE and its component part, not only on ROE, also on its component part. Given these considerations, okay, so after you show the impact, you have to adjust table 1 and recalculate ROE for 2006 only, thereby making it more comparable to the ROE of 2005. Only 2006 you have to adjust, so that now you can compare 2005 and 6. Okay, you have to recalculate what has been calculated already in the table 1 for 12 marks. So most of your marks are here. So if you are not good in ratios, if you don't know how to calculate ratios, you're missing huge amount of marks. You are missing out. And 2 professional marks. So this is question number 4, because your professional marks in section B comes in question number 4. Okay, and the nature of question number 4 is like this in your past paper. Okay, this is how you'll be asked. Some ratios, something like relating to conceptual framework, current issues comes in question number 4. Okay, so professional marks will be awarded for part B for clarity and quality of discussion. This is relating to part B. First 2 marks, first 2 professional marks will be you'll be getting in question number 2 for ethics. The remaining 2 marks will be getting in question number 4 for discussion. It could be any discussion. This is relating to the ROE, ratios, and the usefulness to the investors. So when you talk about the usefulness to the investors, please, not only the financial thing, you also have to talk about the non-financial advantages, usefulness. Okay? And the more you discuss, the more points you have to discuss, the more marks you will get, and hence it will increase your professional marks as well. Okay? So now let us read the scenario to answer. A, you can answer, but anyway, we'll just go through this. This you need for part B. Okay. So guidance is considering the financial results for the year ended 31st December 2006. The industry places great reliance on the return on equity as an indicator of how well a company uses shareholder funds to generate a profit. Return on equity guidance analysis in order to understand the fundamental drivers of value creation in the company. How are they calculated? They are calculated using 3 separate ratios. Remember, one is this, another one is this, another one is this. 1, 2, 3. These are known as component. Net profit before tax divided by sales. Which ratio is this? Net profit margin. Net profit margin. Second, sales over assets. What is it? Asset turnover, you can say, right? Asset turnover. And third, asset divided by equity. Okay. So 3 ratios makes up return on equity. Okay. Hence, okay, the formula is if you short this, okay, it will be net profit before tax divided by equity. This is the shortcut formula for return on equity, because just see here, as you can see here, I will use a different color. Sale is here, first and second. Just look at the first and the second ratio, only forget about the third. Okay, first one is sale is here and the second one sale is here, so you can cut the sale out. You're left with This two, and here just check the second and the third one. Asset you can cut here and asset you can cut here. So what you are left? You are only left with net profit before tax on the numerator, and you are left with equity in the denominator. Hence, this is the formula for return on equity equals to return on equity, net profit before tax divided by equity. But you need to find out like this, okay, separately. So now you have been given the figures for both 2005 and 6. You have been given the sales figure, net profit before tax, assets, equity. Okay. Now special purpose entity. Special purpose entity, and this will be using to answer our requirement B. We don't need it in requirement A, so we can straight away answer our requirement A. Okay. Why we might choose the choices that we choose and how it affects faithful representation and comparability for 6 marks. Now if you see, these are some key answer tips. Let's go through this. This is from the examiner. How you can collect the maximum marks for such type of question. Most of the easy marks are in part B, in ratios. Because it's easy to get marks in ratios. If you know the formula, you know how to calculate. But what happens if you forget to calculate ratios? How can you get the marks? You forget. Or you don't even talk about the impact on the ROE. Then you're throwing away easy marks. These are some easy marks that you're throwing away just simply because you were ignorant and you didn't study ratios. You don't know the formula. So don't do this. Okay. Now, so coming to part A, accounting policy choices. You can even give some examples also where this policy, and through example also you can explain. So if an IFRS standard allows an entity an accounting choice, the financial statements will be affected by that choice, right? Why? Because that accounting policy chosen might be driven by self-interest. One reason is self-interest. You definitely want to choose a policy which will give you benefit. You will think of your self-interest, which will show that your financial performance and your financial position is good. Okay. For example, let's say IS 16. You want to show a higher amount of assets to boost up your assets in the financial statement so that your liquidity position improves. What would you do? You will choose the fair value method, not the cost method, because fair value method will give you the higher amount, higher asset. So you will inflate the amount of an asset. So it is known as self-interest because you have that self-interest. One reason is that. Companies may use the financial choices to increase earnings. Another reason, okay, this is 1 mark. Now you are explaining this self-interest. You have to explain in detail how it is driven by self-interest. So they may use the financial choices to increase earnings or manipulate accounting figure in order to influence the contractual outcomes which depend on the accounting figures reported. Correct? They can manipulate it for their own self-interest. So, before going to the next, let us just read the tutorial note. This question does not explicitly refer to the conceptual framework. However, the conceptual framework is the one which provides guidance for the preparers of financial statements when an IFRS standard offers a choice of accounting policy. And so the principles that it outlines are relevant here, even though they are not saying use conceptual framework, but indirectly you have to use conceptual framework in your answer because they provide guideline. When an IFRS standard offers a choice of accounting policy, what should you do? That's why you need to use conceptual framework here. That is the hardest part to identify in SBR. Direct things is easy once it's given, okay, this is the standard, so I will apply. But some things is hidden, it's indirect, it's hard. So you definitely need to practice lots of questions, need to look at the wordings of it to identify the hidden parts, okay? For example, here, how we have identified that we need conceptual framework to answer this, okay? Accounting choices exist to provide companies which operate under different business model with the option of utilizing an accounting method which best represents their operations, okay? So when an accounting standard offers a choice of accounting policy, what does the conceptual framework says? They state that the information provided must be useful. Number 1. Useful means it should be relevant and as well as faithful representation. And here they talked They are told in the scenario that they are being comparable and faithful representation. That's why we are talking about this two more. One is faithful representation here, one is comparability. We have to talk about this because the scenario they have mentioned. So faithful representation means to the maximum extent possible. These are the three features of faithful representation. It is complete, it is neutral, it is free from error. Neutral means it's not biased towards any stakeholder. Whatever is presented, it is neutral only and free from error. And it's also complete. Okay. Faithful representation is affected by the level of measurement uncertainty. For example, you have a certain item which is very hard to measure. Uncertainty is so much. So if you recognize it in the financial statements, it will not be a faithful representation. Okay. Coming to the next, comparability. This is one of the four qualitative characteristics. Remember the four qualitative characteristics: comparability, understandability, timeliness, and what is the next one? There are four. Consistency, which enhances. So these are the four qualitative characteristics which enhances the usefulness of financial information. Okay, so it's given here. Timeliness, understandability, and verifiability. Not consistency, sorry, it's verifiability. Okay. But you don't have to refer this, okay? Don't mention all this four, it's not required. Only comparability you have to talk about. That is one of the four qualitative characteristics. Okay? You don't have to define comparability. Don't go and define, okay, comparability means that you have to compare the two figures. No. This is not a this is not a F level paper. This is a P level paper. Professional paper. In professional paper, it is expected from you that you apply rather than writing the knowledge or defining what is comparability. Okay. And other things you don't have to write because they only asked about comparability. If you write about other things also, you will not get marks. Hence, you are wasting time. So here, accounting information is more useful. That means they are talking about faithful representation here, and this is for comparability, the second paragraph. Okay, so they are dealing it in two separate paragraphs. Accounting information is more useful if it can be compared with the similar information from other companies or from the same company. Then only that information is useful. Where there's a flexibility, that means they have a choice when applying an IFRS standard. Financial statements can become less comparable with other companies. Flexibility, no, he will choose something else, you will choose something else. However, if guidance in the conceptual framework is followed, companies with the same business model or that hold the assets or liabilities for similar purposes are likely to measure them in similar comparable ways. This is what you need to write in your answer, relating it to the conceptual framework. Okay, if they are same business model, okay, for similar purposes, they will be measured in a similar way. Hence, it will be easy to compare. Coming to comparability, this is crucial to improve the financial reporting quality. But it can be argued that comparability is made more difficult by the fact that board allows entities to choose between alternative measurement bases. Comparability also becomes tough by allowing them choices. Okay? Environmental, economic, political, cultural, operational differences could be solved with the existence of accounting choices in the standards. But these choices could be at the cost of comparability. Okay, that means by having accounting choices in the standard, you can solve these issues: environmental, economic, political, cultural, operational. These differences you can solve, but it comes at the cost of comparability. It becomes very hard to compare them by having these choices. Now, coming to B is for 6 marks. Now let's come to B, usefulness of return on equity to the investor. Okay, the way you write here matters a lot because you are getting the 2 professional marks for part B, and it is for both first part and the second part of B. So first part talks about usefulness of return to equity. Okay, that means we have to talk about 3 ratios, and you can write these 3 separate ratios in 3 separate paragraphs. First one, you're talking about return on equity. Second paragraph talks about net profit margin. Third paragraph talks about asset turnover. Fourth paragraph talks about equity ratio. Okay. And finally, you are calculating here. You are calculating for 2005 and 2006 all the four ratios. Okay. So if you know this layout, always have this layout in your mind. Visualize that this is the way I'm going to write. This many paragraphs I will write. My calculations will be like this. I'm going to end like this. I'm going to start like this. My middle part will consider this. Okay. It becomes very easy for you to write then. So let us start with the first paragraph, which talks about the usefulness of return on equity. This measures the rate of return which the owners of issued shares of a company receive. What is their return on the shareholdings in terms of profitability? Okay, so this is just a definition of return on equity. Second, this metric is especially important from an investor's perspective. Why? As it can be used to judge how efficiently the firm will be able to use the shareholders' investments to generate additional revenues. So, 1 point you will get there. But let us see for how many marks it has been allocated. It is for 5 marks, okay? So 5 points you need to write. So 1 point you will be getting it. Just wait a minute. RO ratio and his component part. So the usefulness of his component part also you'll be getting marks. Okay. Net profit margin, that means net profit divided by sales. This tells us how much profit a company makes on every dollar of sales. Very easy, right? Isn't it? This things is very easy to get marks here because this is something that you know from your previous studies. Asset turnover. This measures the value of the company's sales or revenues generated relative to the carrying amount of its assets. So the asset turnover ratio can often be used as an indicator of the efficiency with which a company is deploying its assets in generating revenue. How efficiently they are using their asset to generate revenue. The equity ratio. This indicates the relative proportion of the company's assets that are financed by equity. The equity ratio is a good indicator of the level of leverage used by the company by measuring the proportion of total assets which are financed by the shareholders as opposed to creditors. The higher the equity ratio, better it is. That means most of the assets are being financed by equity. You're not taking debt. That means your gearing is in control. That's good. Risk is less. Now we need to calculate the ratios. We are done. Okay. And calculating ratio, easy source of marks you will get here if you know how to calculate. And when you're making for 2005 and 6, rather than doing it separately each time, make a 3 column like this. Here you are writing the ratios, name of the ratios here for 2005 and third column for 2006. Okay. And do line by line like this, so it becomes easier also to compare. So first of all is net profit margin. Okay, when you're calculating net profit margin, I will just show for 2005 and 2006 you can do it. So net profit divided by sales, 30 over 200. Okay, which will be 15, I think. I guess it's 15%. Yes, it's 15%. Asset turnover, 0.8 and 1.43 is equity ratio. So asset turnover, that is sales divided by assets. So 200 divided by 250, hence 0.8. And finally, equity ratio, which is asset divided by equity. So asset 250 divided by 175. 1.43 something, right? It was 1.43. And how are you getting this return on equity? Very simple. Multiply all these three. 15% multiply by 0.8 multiply by 1.43. When you're taking 15%, you have to take in terms of decimal place 0.15 into 0.8 into 1.43. You'll be getting 0.17, hence 17%. Same way you have to do for 2006 also. Okay, first. Okay. You might be getting 0.716 something, so you can round up to a whole number. Okay, take it into whole number. Next, so now let's compare from 2005 to 6. If you see return on profit increased, you can have an arrow sign here. Asset turnover increased, equity ratio increased, return on equity increased drastically, doubled, it doubled, more than double also. Okay, Now, so what does it mean? Just see that this return on equity is dependent on the previous three ratios. So if your previous three ratio, if any one of the figure goes wrong, your return on equity will be wrong. That's why be very careful with your ratios, especially when your ratios depend on other ratios. Now we are coming to the second part of B, which is setting up of special purpose entity and miscellaneous expenses. Okay. Adjusted amount, you have to adjust. Okay. And finally we have the marking scheme. But before going to the marking scheme, we need to go through the scenario. During the year end 31st December 2006, guidance stated that it had reorganized its assets and set up a SPE, special purpose entity. Guidance transferred a property to SPE at its carrying amount of 50 million but had incorrectly charged revaluation reserves. Okay, with this amount rather than showing the transfer as an investment in the SPE. So this 50 million they have shown in the revaluation reserve. Okay, rather than showing it as an investment in the SPE. The property was the SPE's only asset. However, guidance still managed the property, and any profit or loss relating to the assets of the entity was remitted directly to guidance, and guidance had no intention of consolidating the SPE. Okay, so first let us answer this part before we go to the next. Remember, for everything you have to comment the impact of ROE and also its constituent elements, the other three ratios. So by transferring their assets to this one, asset is going, no? So asset turnover ratio will significantly larger, making the entity look more efficient, isn't it? Just okay. Furthermore, the revaluation reserve has been charged. So because of this, thus reducing equity and improving the ROE ratio. ROE ratio. Why will it look significantly larger when you transfer the asset? Your asset is going down. When your asset goes down, your asset turnover ratio increases. What is the formula for asset turnover? Sales divided by asset, no? So when this goes down, denominator, that means you are dividing by a smaller amount. This number will increase. Let me show you with a practical example with some numbers. Let's say sale is 10 million and asset is 5. Now it is 2. Your asset turnover ratio. But when the asset goes from 5 to, let's say, 2. So 10 divided by 2 equals to 5. You see, this increased because this reduced. The asset reduced. So when you transfer the asset reduces, hence your asset turnover ratio will increase. That means it make your entity looks more efficient than actually it is. And also you have charged a revaluation reserve. So because of that, it will reduce your equity and improving the ROE ratio. So when your equity reduces, your ROE ratio increases. How? What is the formula for return on equity? That is profit before tax, interest and tax divided by equity. So same, if this falls down, equity falls down, ROE will increase. Okay. Now, which standard to apply? You need to use a standard which is IFRS 10. You need to use the knowledge of IFRS 10 to explain why the treatment of this is incorrect. Because they told that they have no intention to consolidate. That's why you have to talk about IFRS 10. The word consolidation is enough. Okay. So when it comes to this thing, IFRS 10, what does it say? Control. You have to talk about the word control. States that an investor controls an SPE when it is exposed, has right to variable returns from its involvement with the SPE and also has the ability to affect those returns to its power over the SPE. But the power is the current ability to direct the activities which significantly influence return. That means they have the power that they can change the return. Whether they exercise that power or not, that does not matter. But they should have the power. As such, the SPE should be consolidated by guidance in its group financial statements. Okay? Because they have the power. The property should be included in the group's asset. That's why the property also should be included in the group assets, and hence it should be eliminated from the revaluation reserve because it was incorrectly there. This adjustments will increase the shareholder equity. Earlier it was reduced because of revaluation reserve. Now it will increase. And now if shareholder equity is increased, it will reduce your ROE. The opposite will happen now. Okay, just give me a minute to go through this again. Okay. Okay. Now, another good question students usually most of the time ask me, okay, that how do we know whether we have to apply IFRS 3 or IFRS 10 because they look very similar. IFRS 3 is business combination. There also we consolidate subsidiaries and all. IFRS 10 is on consolidated financial statement. That is also on consolidation with standard to use. So in the scenario, you need to look out what exactly they have asked you, the requirement. For example, if the requirement asks whether an entity has a control over another entity or whether an entity should be consolidated. So the word consolidation, okay, that gives you a hint that you have to use IFRS 10. Whenever the word control is there, whether an entity has control, whether entity should consolidate, you have to look out the fact from IFRS 10. Business combination, on the other hand, could be anything, not just control. It could be associate, it could be joint venture, it could be anything. Okay. In business combination, they will ask you a question whether this is a business combination or this is a purchase of an asset. Business combination means you have purchased an entity, for example, subsidiary or associate or joint venture, or is it an asset? And also, IFRS 3 mostly comes in your group accounting. That is, they will give you the goodwill, the NCI, the net assets, all these things. Then we use IFRS 3. But the moment you see control or consolidation, it is IFRS 10 or IFRS 3. Okay. So coming to the next. Guidance has brought back that means share repurchase 25 million shares of $1 for 1.2 per share during the year ended 31st December 2006 for cash, and also they have cancelled the shares. This transaction was deemed to be legal. Guidance purchased 25% interest in an associate company on 1st of July 2006 for cash. The investment had a cost of 15 million. An associate had made profit of 32 million in the year 31st December. In the year to 31st December 2006. This was on 1st of July 2006, so for 6 months. Guidance accounted for the purchase of the associate correctly. Purchase of the associate, he have done it correctly. Okay. The transactions have been accounted for in the financial statements provided for the year ended 31st December 2006. This miscellaneous transactions has been accounted for in the financial information. Okay. So now we need to correct it. We have to basically tell the impact on return on equity and the other ratios. Okay. So major concern. There are two aspects. One is share buyback. What is the impact? The other one is what is the impact of an associate, and then we have to correct also. Okay, don't forget. And it's for 12 marks. So share buyback. A major concern about using ROE is when a company buybacks its shares. Why? Equity will fall. Equity will fall down, no? Shares. Because this decreases the equity. So when the equity is decreased, what happens? ROE increases. This decreases the equity on the statement of financial position. As the equity portion of ROE shrinks, ROE matrix gets larger. So the ROE calculation can become meaningless if a company regularly buy back its shares. It becomes meaningless. to use this calculation. If they regularly buy back its shares because equity falls down, ROE increases. So as a result, there may be better metrics for investors to use. One is PE ratio, price earning ratio, right? Because price is something that is dependent on the market. It is not in your control. You cannot manipulate that. Okay, earnings. In earnings, when you buy back the shares, it will not have any impact on the earnings. So price earning ratio might be better indicator, right? Just give an example because I just have to see whether they told to recommend some improvements or not. Okay. So discuss the impact of this and this on the ROE and the component part. Okay. So you can tell some other measures also that might be useful, because remember the two professional marks. So if you give recommendations like this, even though they didn't ask, for example, here you told that better metrics might be PE ratio. So recommend like this because you have the two professional marks. Okay. And what is the accounting treatment for the share buyback? Even though this is not asked, but for your understanding. So this might help you to have to write the impact on the ROE. You debit equity, you credit cash. That means the equity is falling down. Equity falls down, ROE increases. Inverse relationship. Okay. Coming to associate part. Remember, it was for 6 months. So when you're comparing it with the previous year, you cannot take it because in the previous year there was not an associate. So this is likely to affect year-on-year comparability. So striping out the impact of that investment, you are taking out the impact of that investment, then it might provide more relevant trend. Okay. So now they have included 4 million profit. How? 32 into 6 over 12 into 25%. You have taken associate for 6 months into 25% into 32 million. The profit 32 million. We'll check. This was the profit 32. This 32. And you have to take 25% and for 6 months because July to December. Okay. And we definitely have to work out on this part as well. When you are calculating, we bought 25 million of $1 for $1.2. Okay. So this 4 million from an associate in the current year's figure. So when you include this, what happens? The associate was purchased in the current year. If the share of the results of the associated were excluded, this would allow their profitability to result exclusively from their asset base. So if that profit is gone out, whatever the profit guidance have, it is exclusively taken from the asset base only, guiding company's asset base, not from an associate if you exclude that. So it could be argued that the full value of the company's reported profit, including the associate, could distort. If you're taking the associate's profit also, it could distort the analysis of their performance compared to the last financial year. Okay. So there is no need to adjust the original 50 million investment. You don't have to adjust this in the associate. Why? Because one asset is merely being replaced by another, but total assets and total equity remains the same. If something remains the same, if you are not adjusting, if you don't have, it's not impacting, still you have to write it. For example, the last paragraph. Why you don't have to write it? 50 million original investment, you don't have to adjust. Because you are replacing one asset with another. For example, you are giving the property, but you are buying an associate. It's an asset. It's an investment in an entity. It's an asset. So one asset is being replaced by another. Okay. Therefore, the total assets and total equity remains the same. Okay. Now we are coming to the adjusted amount. Calculations and all. And the way you present here matters a lot. Professional marks. Please take care of your professional marks. Examiner commented that better quality answers used a table to show the adjustments needed to 2000 figure. Label the table. This provides an audit trail for the marker, making it easier for them to give you credit if you make a mistake. Label it, write the number, put it in a table. and take away your professional marks. Okay, so coming to this for your original figures. So make sure that you write the original figures beside it, so then you don't have to refer and turn your pages every time to the scenario. Okay, it's in front of you. It saves a lot of time. Keep your calculator, everything ready. If you're doing Excel, make sure that you are working fast on Excel. You have to work on that also while you're practicing. So when it comes to SCP property, 50 million, right? So it will increase the asset and equity. Okay. Coming to the shares cancelled. Associate the profit we have just taken, net profit before tax, 4 and 4. You are excluding it. Okay, that 4. Because last year there was no profit. You need to compare with 2005. You have to adjust it. So that's why you're taking the profit of the associate out. Okay. This you need to consolidate. That's why you're taking this 50. Coming to the shares cancelled. Okay. It is 30. How it is 30? So here the figures are not written, but we need to work out the 30. Okay. So if you see here, they bought back 25 million shares of $1 for 1.2. So it will be 25 into 1.2. Okay, which is 30 million shares. So you have to take this into the picture, add it. So these are the total after you get it. Now you put this total here. This is the second adjusted calculations. Okay. So this were the one you got in 2005. You have calculated previously, just copy pasted, and 2006 unadjusted. This was before you have calculated. With this you have compared it previously in part A. Now this figure you are writing here. You have to calculate this ratios again, adjusted, unadjusted and adjusted. Okay. Make sure that you write the 2006 adjusted in this column, second column only, so that you can compare it to 2005. And 2006 unadjusted you keep on exactly on the right side. Okay, one column. So you need to calculate these ratios again by using these ratios. Hopefully you will be able to calculate the ratios. And if you see now, compare. Net profit margin increased from 15 to 15.5. It's better, no? It increased slightly. Before it was 17.3 when it was unadjusted. Now 0.8 to 0.76, it fell down. Correct, because asset turnover will fall down because asset we have adjusted that, no? Equity ratio is increasing and ROE is also increasing, but slightly. Okay. Whereas before it was too much, it was double when we didn't adjust. So now you need to write, you need to explain now. So it can be seen that the impact of the transaction in the period were eliminated. And then ROE and its component parts significantly reduced. ROE also reduced compared to 38 to 19.3 and its component part also. So the buyback of shares, okay, rather than writing this increase, this decrease, this increase, don't write it like that. Just write the ROE and component part significantly reduced from unadjusted figure. That's it. Because professional marks matter on the way you write, how you present your answer. So the buyback of shares, specifically you can talk about buyback of shares as well as the purchase of the associate. They were legitimate transactions, but they have been eliminated in order to determine the comparative matrix. How are you going to eliminate them? For example, buyback of shares. When you buyback of shares, what do? You reduce it, no? You reduce it from shares. But here That means the share cancel you need to add because you're eliminating. On elimination, you are doing the reverse of it. To eliminate, you add. That means it will reduce your asset and it will reduce your equity. So if it reduces your equity, okay, your ROE will go up, no, which is incorrect. You need to eliminate that. That's why you are adding this 30 here. And this you are adding because you have to consolidate. Okay. And associate you have to deduct because that associate was not for the, it was not there in the previous year. You have to deduct the profit from both equity as well as net profit before tax. Okay. So the accounting treatment of SPA was against IFRS 10 because they didn't consolidate and would have been reversed in any event. Although financial metrics are intended to enable comparisons between companies, the relative performance of any particular company may be affected by transactions both acceptable as well as unacceptable under accounting standards. So it can be affected, the performance ratios can be affected by many things, whether it is acceptable or unacceptable under accounting standards. Both ways accounting ratios can be affected. Okay, but make sure that you know this. This matters a lot. Okay, this table, how you eliminate it, that matters a lot. If you are not understanding this, let us go to the this thing. Okay, let us go to this one, this addition and reduction. Most of you might be still worried about it. So again, let me take you to the profit first. Okay, profit you are eliminating, so you deduct. That is understood. Coming to here, equity you debit when it comes to share buyback. So when it is equity is going down, ROE will increase. So you need to eliminate that impact. That's why you are adding that 30. Okay, and coming to the SPE, that 50 million here. So when you're transferring that, that means your asset will reduce. So when you're reducing your asset, your ROE will increase. So you have to eliminate that increase in ROE. That's why you are reversing it. So rather than deducting, you are now adding it. Now I hope you will understand this picture better. That's why we are adding to eliminate the impact, the increase in ROE. You are adding 50, you are adding 30, minusing 4. Okay. Now we are done with question number 28, and finally we are moving towards the marking scheme. Okay. So the marking scheme, the 6 marks are divided equally between the issues that relate to accounting choice as well as the faithful representation and comparability. How they are affected. 3 marks. Coming to the next one, which was for 5 marks. One is meaning of return on equity and its component part is 3 marks. Second, for calculation is 2 marks. Did you see discussion is always more marks than the calculation? Okay. For 2005 and 2006, even though there are 4 separate calculations for 2005 and 6, still you'll be given 2 marks. That means you have, your ratios has to be correct. All the answers for 2005 have to be correct to get 1 mark. All the answer for 2006, all the 4 ratios for 2006 has to be correct to get another mark. Hence 2 marks. Okay. Coming to the last. How do you get this 12 marks? 3 marks for the transfer of property, 3 marks for the buyback of shares, 2 marks for the purchase of associate because less work are required, no? Just eliminate the profit. Here, so you have to do calculation also. And finally, 4 marks for the calculation of the impact of ROE and also its component part. 4 part because first you have calculated, first you need to calculate this table. Then you have to calculate this table, okay? This ratios you have to calculate here. So 4 marks. And also explain. So altogether 4 marks. Now we are going to the examiner's comment. Answers to part A are well presented. That means they have good description of the assets and the liabilities. Okay. At a potential cost to comparability, which is an enhancing qualitative characteristic. So generally that means students have good understanding of conceptual framework. So which is good. Few answers consider the need to best represent the business model of the entity. What about second part of B? This was also well answered in general, okay, ratios and all. Surprisingly, that means examiner was surprised that few candidates provided clear description of the component element of ROE. That means profit margin, asset turnover, they have described it correctly. even though the requirement clearly didn't ask for it. Okay, despite the requirement clearly asking for it, they didn't ask clearly to give the description of ROE. They just told the impact on the component part. That's it. Still, students explained it correctly. Second part of B, which is worth 12 marks. Most candidates identify the impact that the transactions will have on the comparability of the current year's ROE. Also, better answers provided a table also. Some of them provided a table. Okay. A methodical approach. You need a way, you need a correct method, correct system to approach this answer. Okay. So methodical approach yielded good marks. If you're following this method of providing in table, okay, you will get good marks. But what about the weaker answers? They present unclear workings. First of all, workings are not labeled. It is not in a correct way. Some are here, some are there. They are not making any reference or commentary. They are not commenting on that result. So they are losing marks. But overall, this question was well answered. That means this shows that students are good in conceptual frameworks and ratios. So this shows that you need to learn ratios as well as the conceptual framework. Definitely, conceptual framework, no doubt you will get. But ratios, at times you get, at times you don't get, but be prepared for it, okay? Because these are some easy marks that you can get. If you get ratios, you're lucky, in fact. Okay, and if it comes as a 25 marks question, then 25 marks. I would say out of 25, let's say 20 marks is secured, right? Because the two professional marks, if you get, then, then what else do you need? It's a bonus for you. So make sure that you work on these things, ratios and all, and see you in the next video. Till then, take care.